Chad Slater is the Co-Chief Investment Officer at Morphic Asset Management. He joins me live in the studio to discuss where he saw investing trends over the past 6 months and was Morphic right or wrong on them. Chad Slater, nice to see you.
Good to see you as well.
Now, firstly, I thought we would look back at the 6 months, some of the calls you made, but are you into Bitcoin?
Sadly, no. Though that said, on Christmas holidays, just about every person in my extended family had an opinion on it, which tells you a little bit about what type of cycle this is.
When you say sadly, though, surely you mean that, do you mean that this is not one to be touched with a barge pole, or do you actually mean you missed out when the price was, $10 a Bitcoin?
You know the old joke is that a bull market is something that you're in, and a bubble is a bull market that you're not in.
Yeah, exactly. All right, let's go and look now. One call you made 6 months ago, or in the last 6 months, emerging markets will not finish the year 2017 higher than current levels. Now, that was a miss.
Yes,
emerging markets, the rally did carry on, I think, to finish up 34%. Why did you miss that one?
You've got to pick the one that we did the worst in, don't you?
Yeah, well, we'll start off that, and then I'll let you end on a positive note.
Look, emerging markets through time have made investors a lot of money by being invested in them, but they're usually quite volatile. So you often have a 10 or 15% fall in that. So you might make 20 in a year, but you go down 10 at some point. At the middle of the year, the emerging markets had not fallen by more than 2 or 3% at all. So we thought weighted probabilities would suggest, and you're already up 20% by the middle of the year, that your best returns were done. Now, this turned out to be the 1 in 100 chance where you don't actually have any falls at all. So it's set a new record for emerging markets, no falls greater than 4% for a whole year.
Amazing. Did you, even in the time when you were in it and it was still rising, did you make some money on it?
We did and we didn't. So net we didn't. Because our call was that it would go down at some point, we did short it and lost some money on that. But overall, through the year, we did make a little bit of money out of it, but sadly, it wasn't one of our best.
All right. Well, one of your best probably was the call that Japan will not underperform global markets.
Yep.
Japan's been extraordinary, hasn't it?
Look, you know my colleague Jack, he's on the show quite often. We do speak about Japan a lot.
Yeah.
And your viewers be aware that we have strong views on Japan.
And you've been very for Japan for quite some time.
Yeah, we think it's an undiscovered gem hiding in plain sight. It's the world's third largest economy still, and everyone had pretty much given up on it. And to be honest, around September our call wasn't looking that good, but the back end of last year things really got moving, and I think everyone returned back to Japan, so the call worked out for us.
But why did you get that right? Why did you punt that Japan would be strong?
I think the thing we really like about Japan is there's structural fundamental change taking place, which is companies are being run for shareholders and not for cross-interest. Now, the thing that's been missing from Japan is they make great products. No one can dispute Toyota is an awesome maker of automobiles. Yep. But the businesses were never always run for shareholders. And what
they were run for a little elite coterie?
Yeah, so both Japan and Korea, in Korea's case they're called the chai bowls, were run for cross-shareholding ownership structures. Shareholders, external shareholders in particular, weren't always first in front of mind. And it's one of the unsung reforms of Abenomics is that they do seem to care more about shareholders. And I think Western people like us are getting more back into Japan. All
right, now tell me about your call on global bond markets, because we have since, in recent, really over the Christmas period, seen this, another turnaround in bonds.
Yes, our call last year was that bonds would go nowhere, which sometimes I think people always want a call to happen, like if it's going to go up, it's going to crash, etc. Sometimes saying it's going to do nothing is one of the more difficult things to do, and it worked out for us.
That's right, it didn't go anywhere on yields.
So everyone last year at the start, remember, thought that the bond yields would surge last year. And by the middle of the year, they'd sort of come back to about 2.3% here in the US. And what we thought was really what you'll see is a flattening of the curve. So this is the Fed will keep raising rates, but the long end's not likely to go up that much. I mean, it played out that way. I don't think 2018 is going to be the same, though.
All right, just briefly on Australian interest rates, let's step forward to this year. What do you think the RBA is going to do?
Look, we think they can probably hike by at least once or twice. So everyone goes, oh, there's no wage growth, therefore they can't hike. Remember, wages are backward looking. The RBA is paid to look forward. And so if you
there's no inflation either. Is there enough to push them to do that?
Remember the old dictum that monetary policy works with long and variable lags. So if, last year Australia created the equivalent of 350,000 jobs a month. If that keeps happening, you're going to see a low 4% unemployment by the middle of this year. If you see that, the RBA knows they've got 12 to 18 months before things start to really happen again. They'll be hiking by September.
Yeah. All right.
if nothing changes.
Okay, so not till September, so not in the first half.
Probably not. They're going to give this a bit more time.
Yeah.
But they'll want to start setting things by June, we reckon.
All right. Chad Slater, Co-Chief Investment Officer at Morphic Asset Management, thanks so much for joining me.
Cheers. Thanks, Helen.
Good to talk to you.